Good day everyone, you're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we will be discussing simple signs to look out for before you buy that stock. Many people want to invest in stocks, but the big question is, how do I know the right stock to buy? Should I rely fully on my own research or should I listen to market experts and professional advisors? The truth is that both are important. However, even if you're working with an advisor, it is still useful to understand the basic things to look out for before putting your money in any stock. Stock metrics are simple tools that help investors assess, compare, and monitor companies. They do not guarantee that every investment will be profitable, but they can improve your chances of selecting strong companies and avoiding weak ones. For beginners, these metrics are a good starting point. Now that most first quarter results are out, investors have fresh evidence to separate strong companies from weak ones. The numbers will likely shape market direction in the coming weeks as investors respond to earnings performance, profit growth, and future dividend potential. When investing, the aim is to identify companies that are strong, well-managed, profitable, and positioned for long-term growth. Below are some simple metrics to consider when selecting stocks. 1. Revenue/sales growth. Revenue simply means the money a company makes from selling its products or services. A company with consistent sales growth is usually doing something right. It may be selling more products, increasing prices, expanding into new markets, or enjoying strong demand. As an investor, look at the company's sales trend over at least 5 years or quarters. Is revenue growing steadily? Is it moving up and down without direction? Strong and consistent sales growth can support future profits and may also lead to an increase in the share price over time. It is also important to understand what the company sells, who its customers are, and whether demand for its products can continue to grow. Consider competition, government policies, inflation, exchange rates, and other factors that may affect the company's costs and profitability. 2. Consistent dividend payment. Dividend is the portion of profits that a company pays to its shareholders. Think of it like a reward for owning the stock. In Nigeria, many investors love dividend-paying companies because they provide regular income in addition to the possibility of share price appreciation. A good starting point is to check whether the company has paid dividends in at least 3 of the last 5 years. This shows some level of consistency. Another important metric is dividend yield. This is calculated by dividing the dividend per share by the current share price. It helps you compare the return you are getting from different dividend-paying stocks. However, don't buy a stock only because of dividend. The company must also be profitable and healthy. 3. Consistent growth in profit. Profit is what remains after a company has paid all its costs, expenses, interest, and taxes. For shareholders, profit is very important because dividends are usually paid from profit. A company that consistently grows its profit is more likely to reward shareholders over time. When reviewing a company, check whether profits have been rising over the years or over the quarters. If a company suddenly reports a loss, find out why. Was it caused by a one-off event, or is it that the business is becoming weak? If losses persist for a long time, it may affect the company's share price and reduce the likelihood of dividend payments. As a beginner, it is safer to focus on companies with a clear record of profitability. 4. Strong leadership. Behind every strong company is a strong management team. Good leadership can make a major difference in how a business performs. A company with experienced, disciplined, and innovative leaders is more likely to grow revenue, manage costs, and respond well to challenges. Before investing, pay attention to the people running the company. Do they have a good track record? Are they respected in the industry? Have they delivered results in the past? Strong leadership reduces risks and builds investor confidence. 5. Positive news and market information. Stock prices often react to news. When a company releases strong results, announces dividends, launches new products, wins major contracts, or benefit from supportive government policies, investors may become more interested in the stock. This can push the price up. On the other hand, negative news such as weak results, regulatory issues, rising costs, poor management decisions, or unfavorable government policies can bring the price down. This is why investors must stay informed. Don't just buy and disappear. Read company announcements, follow market updates, and pay attention to economic news. Investing in stocks requires patience, discipline, and ongoing learning. If you do not have time to monitor individual stocks, you can consider equity mutual funds, in which professional fund managers invest on your behalf. For investors with large portfolios, it may be useful to work with a Securities and Exchange Commission registered asset management company for proper monitoring and guidance. Finally, for those interested in foreign exposure, exchange-traded funds such as the Vanguard S&P 500 ETF, VOO, can provide access to a broad range of top US companies. In summary, don't buy stocks blindly. Look for companies with growing sales, consistent profits, reliable dividends, strong leadership, and positive long-term prospects. The better you understand what you are buying, the better your chances of building wealth over time. Thank you for listening. Please join us same time next week for another insightful and interesting session. For questions, comments, or feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed and have a great week. Bye.